Hi everyone, welcome back to Trading Options Network. Hey, just like anything else, if you want to become a professional, you have to know the basics. For example, I would not have been able to teach high school math if I didn't understand arithmetic. Well, when it comes to trading, in my opinion, candlestick analysis is the arithmetic. You'll never become a successful trader if you do not understand candlestick analysis. In this training, I will go over what a candlestick looks like, what a candlestick represents, and a few basic candlestick patterns. The truth is, I can write an entire book or develop a months-long training solely on candlestick analysis, but with that being said, you'll find more detailed candlestick analysis videos in the future from Trading Options Network. However, this video is designed to go over the basics of candlestick analysis. Now let's get started. For you history nerds out there, a candlestick was invented all the way back in the 1700s by a rice farmer that realized there was a correlation between the price of rice, supply and demand, and consumers' emotions. Almost 300 years later, it is still used today as the most basic yet important form of technical analysis and trading. Now, why do I bring this up? Have you ever heard the term, if it ain't broke, don't fix it? A candlestick in its most basic form is a near-perfect representation of the market for a specific time frame represented by the candlestick. With all that being said, let's go ahead and get into the actual training. So what does a candlestick look like? Well, if you think it looks like a literal candlestick you may have on your table or mantle, you're pretty much right. A candlestick is represented by two parts created by 4 price points. Now in this video, I'll assume the time frame we were referring to is one trading day. Now the body is a thick bar that represents the open and close of the day. The other part of the candlestick is called a wick, shadow, or tail. The wick is a skinny line that can be above or below the body, and it represents the high and low prices of the day compared to the open or close of the day. Now, most trading platforms will allow you to choose between basic candlesticks or hollow candlesticks. Now, personally, I just prefer basic candlesticks, but I will go over both in this video. Let's first take a look at your basic candlesticks. As previously mentioned, a candlestick is made up of the body and the wicks. A candlestick will also be one of 3 colors: green, red, or black. A green candlestick simply means the close was higher than the open, and a red candlestick means the opposite. The close is lower than the open. If a candlestick is black, it means the open and close were exactly the same. We will talk more about this scenario later in this video. Now let's take a look at hollow candlesticks. The premise of hollow candlesticks remains the same as with your basic candlesticks. However, it simultaneously compares the current day's open and close and the current day's close with the previous day's close. The color of each candlestick is now determined by comparing the current close to the previous close, and the body, whether hollow or filled in, is determined by comparing the current day's open and close. If today's close was higher than yesterday's close, the candlestick is green. If today's close was lower than yesterday's close, the candlestick is red. The body is hollow if the day's close is higher than the day's open, but is filled in if the day's close is lower than the open. Now, it's possible that a stock can finish at the same price point on consecutive days, and if this happens, you will see a black candlestick. Because of all the possibilities in hollow candlesticks, you could see 9 different hollow candlestick outcomes. So what is it called when a stock opens and closes at the same price and has no body, looking like this? When this occurs, it's called a doji. While technically speaking, a true doji means the same open and close, most traders consider a doji to be virtually the same open and close, or say, for example, an open and close that differ by about 0.1%. The interesting thing about dojis is that they are typically neutral on their own, but when paired with other candlesticks can mean so many different things. Now, let's first take a look at some bullish doji reversal patterns. They're all, for the most part, going to look very, very similar. It's going to be a downtrend, followed by a doji, and then into an uptrend. This particular one is called a long-legged doji reversal. The reason why is because it has a long upper and lower wick. Now keep in mind, if you are ever going to trade a doji, You always need confirmation. A confirmation candlestick is the candlestick that comes directly after the doji. If you do not have confirmation, you do not make a trade based on this doji. The next one is called a gravestone doji reversal. A gravestone doji is essentially a doji that has a very short lower wick and a very long upper wick. Now, opposite of that is a dragonfly doji. A dragonfly doji is, again, opposite. It has a very short upper wick and a very long lower wick. As I had mentioned before, most traders would consider a doji to have virtually the same open and close. As you can see here, this one does actually have a very small body. It also has a very short upper and lower wick. This is called a morning star, and it typically happens at the very bottom of the downtrend, followed by the uptrend. Now the next one, very similar to the morning star, is called an abandoned baby. And no, I did not make this up. It is actually called an abandoned baby reversal. It's essentially the same as the morning star. However, it gaps down first. Then there's a day of indecisiveness. Then it gaps back up into the uptrend. Again, that's called an abandoned baby. Now this next one will actually resemble a dragonfly doji, but because it does have a small body, it is now considered a hammer reversal. Just think Thor's hammer. Very simple. Also, like the gravestone doji reversal, this is the inverted hammer reversal. Again, it does have a small body, but it is Thor's hammer upside down. All right, now let's take a look at some bearish doji reversal patterns. Now I am going to go through these relatively quickly because they are essentially the exact same as the bullish doji reversal patterns, just the mirror image. It'll be an uptrend, followed by the doji, followed by a downtrend. As you can see here, we have our long-legged doji reversal. We also have the gravestone doji reversal and the dragonfly doji reversal. Now, unlike a morning star, this one is called an evening star doji reversal. This one is called a hanging man doji reversal, and this one is called a shooting star doji reversal. Now, there are many, many others. And is it important to know all the names of these different patterns? Of course not. The important thing is that you see a trend followed by a doji, followed by confirmation into a new trend. So in the case of a bullish doji reversal pattern, it's a downtrend followed by the doji, followed by an uptrend. And in the case of a bearish doji reversal pattern, it is an uptrend followed by a doji, followed by a downtrend. A doji reversal is especially strong if it has other technical components that coincide with the doji reversal, such as crossovers of moving day averages, or the MACD, or RSI, all of which are things you'll learn in future videos. Now, you have seen some doji reversal patterns. Let's look at some other very common candlestick patterns. The first one we're going to look at is called an engulfing reversal pattern. An engulfing candlestick is simply just that. It's a candlestick that completely overshadows the previous candle and moves in the opposite direction. In the case of a bullish engulfing candlestick, we're going to have a downtrend that finishes with a nice red bar and then is followed by a huge green bar that not only gaps down below the previous day's close, but it actually moves up throughout the day and then finishes even higher than the previous day's open. A bearish engulfing candlestick is, of course, the opposite. We're going to be in an uptrend, finishing with a nice green bar, and then it's going to have an even bigger red bar that actually gaps up and then throughout the day moves down and finishes lower than the previous day's open. These next two patterns, also opposites of one another, are very similar to the engulfing patterns. The only difference is that the second bar does not completely engulf the first bar. In the case of a piercing line candlestick, we're going to see a candle that still gaps down and then finishes higher than the halfway point, essentially, of the previous candle. We also really don't want to see a huge upper wick, because if there's a large upper wick, then that tells us that the bears actually came back and brought it down quite a bit. The bears may still be in control. The dark cloud cover is essentially the opposite of the piercing line. We're going to see a nice big green candle followed by a gap up and then a candle that essentially goes down throughout the day, finishing below the halfway point of the previous candle. Just like the piercing line, we don't want to see a long upper shadow. In the case of a dark cloud cover, we do not want to see a long lower shadow or wick. If that's the case, it went down and then came right back up. That tells us the bulls may still be in control. Now this next pattern is called the 3 white soldiers bullish reversal. It's quite a mouthful. What you're going to see here is a downtrend followed by 3 very nice green bars. Notice that none of the bars have long wicks on either the high or low ends. Also, the green bars do not gap up or down very much. They start almost at the exact same spot and just continue to move up throughout the day. If you see 3 of these in a row, this is called the 3 white soldiers pattern. It is a very strong reversal pattern. Now, of course, we do have something that's opposite of that. In this case, it's the 3 black crows bearish reversal pattern. Again, it's exactly opposite of the 3 white soldiers. We're going to have a nice uptrend followed by 3 very big, nasty red candles. None of those candles will have very long wicks. And as you can see, they do not really gap up or down. They just essentially are a continuation for 3 consecutive days. This is a very, very strong bearish reversal pattern. Now, you may see something like this, the rising 3 continuation pattern. This is not actually a bullish reversal. It does somewhat look like the 3 white soldiers, but the difference is you have a very, very big red bar, and those 3 green candles, while they do have slightly longer wicks, they do have some gap downs, but they do not actually go above that large red candle. Typically, if you see something like this with a very large red candle followed by 3 green candles that don't move very high, and then you see another red candle afterwards, that is an extremely strong continuation pattern that this downtrend is going down even farther. Of course, on the flip side, we also have a falling 3 continuation pattern where we have a nice green candle followed by 3 red candles, where they may gap up, they may have some wicks, but they don't actually go lower than that first green candle. If these 3 red candles are then followed by a green candle, that's a nice move up, then again, this is a very, very strong confirmation that we are going to be moving up higher in this uptrend. All right. While we may have only scratched the surface of candlestick analysis, I really do believe that this video is going to help you significantly in understanding candlesticks and how they work. But what would be a training video if there was no review, right? What is a candlestick? A candlestick is a type of price chart used in technical analysis that displays the high, low, open, and close for a specific time frame. Candlestick analysis is the ability to read a candlestick to determine potential price movement based on overall market sentiment, supply and demand, and price. The body of a candlestick is the thick part of the candle created by the open and close of the stock in a specific time frame, and the wick, also known as the shadow or tail, is a thin line above and or below the body that represents the high and low of the stock for a specific time frame outside of the open and close. A doji is a candlestick that has an opening and closing price that are equal, and again, as I mentioned a few times before, most traders will consider a very close open and close as a doji. And last but not least, a candlestick pattern is a specific sequence of candlesticks that can be used to determine the most likely future movement of a stock. Well, there you go. You now understand the basics of candlestick analysis. If this video helped you in any way, please don't forget to subscribe to my YouTube channel at youtube.com/@thetradingoptionsnetwork. Find me on Facebook, Instagram, TikTok. Follow me there for all kinds of updates. And again, I really appreciate everyone for choosing Trading Options Network. Have a great rest of your day, and God bless.